Okay, so now you see us on the balance sheet. Again, remember, task one should look something a little bit like this. Don't worry that it's a little bit red. That will go green. So let's take a look. And there's going to be a lot of red here. And again, once we get through the cash flow statement, it will go green because all three of these statements link together. The balance sheet, assets minus liabilities equals equity. And we're going to start with current assets, total assets, and then move through to current liabilities, total liabilities, total equity, and make sure, fundamentally, very important, that equity plus liabilities equals assets and the balance sheet balances, because if it doesn't, then you've done something wrong. So the first thing I'm going to do is I'm going to take total cash. Total cash, you have to go all the way down here and go to cash at end of period on the cash flow statement. And look, it's going to go red. That's absolutely fine because we haven't done the cash flow statement yet. Absolutely fine. Some green items should start coming when I do accounts receivable. So that's an asset. That's people clients that owe us money. So we treat that as an asset. Accounts receivable as a percentage of revenues. As you can see, I fixed it at 15.8%. Again, these assumptions are driving everything. And I've been very generous by giving you these assumptions. And again, I'm using that shift function and copying across. Inventory, well, again, just make sure that you're looking down at this assumption. It's as a percentage of cost of goods sold because inventory is related to the eventual cost of the good that is being sold, as opposed to the revenue. And it's 31% of cost of goods sold. And then other current assets, well, let's take a look at this. Other current assets should, again, be a percentage of revenue. These are the drivers that are going to make us better understand the company's net asset position, its assets, its liabilities. And I'm just going to sum it all together, and its working capital. I'm summing all of the current assets together, and it's going to go red because cash hasn't filtered through yet. But when we do sort out our cash flow statement, let's just check up at the top and make sure that everything goes green. Net property, plant, and equipment. Well, look, you take the previous year and you add on capital expenditures. So you add on capital expenditures. So there you go. And by adding on, I mean it's plus minus M110. And then you take away depreciation. So you take away your depreciation line because that's how much your property, plant, and equipment is depreciated by. So depreciation goes down, in this case, by 2.594 billion. And that should go green. So remember, previous year, plus M110, which is your CapEx. You obviously have to turn the negative into a positive from the cash flow to the balance sheet, and then minus your depreciation and amortization. And look, that should go green. Goodwill? Well, goodwill just stays fixed because we are not making any other acquisitions. Goodwill is associated with the purchase premium relative to the equity value of the company that you're buying. So we're not assuming that NVIDIA is going to buy any companies out into the future. So we just keep it fixed at 13 billion. And then we sum everything together, including total current assets. And again, it will go red. Remember, it will go red because we haven't got that cash line in. Once we sort the cash line, I'm just going to clean this up by going ignore error, just so the little green boxes go away. Then we get through to accounts payable. This is a liability because we owe suppliers money. And accounts payable is a percentage of COGS, and it's 16.2%. By the way, we want our accounts receivable to be higher than our accounts payable. So that means that our working capital position is likely to be a lot better. And we can see here that it is, which is great. Short-term debt, keeping it fixed at 1.25 billion. Let's not change that for now. That would oscillate, but for the purpose of this simple model, we're just going to keep that short-term debt the same. Other current liabilities, let's just take a look. Other current liabilities, percentage of revenue, you should be getting this by now. Drive down to assumptions, make sure that we've got the right assumption, multiply it by the revenue or the COGS line. Total current liabilities, well, hopefully this will go green because I've got everything right. And it does. Fantastic. Long-term debt. Well, long-term debt is the previous year's debt minus any debt repayment. And you can see that there is a debt repayment schedule down at the bottom of the assumptions. There you go. I've given you other long-term liabilities. Again, you don't have to worry too much about that. And then we sum up, including total liabilities, total current liabilities, and we copy across. Total equity. Well, look, this is the balancing item. Don't do a goal seek or don't do total assets minus total liabilities to get to that balancing item, because that just doesn't, that's not best practice from a balance sheet perspective. What we need to do is we need to take the total equity and then we take some cash flow items. We take net income. Again, let me just make sure that my Excel is working properly. So add net income, add stock-based compensation, add dividends paid, which is a minus, so effectively subtracting it, and then add stock repurchases, which again is a minus. So what we're saying is that equity, and this is going to be, let's just make sure that this is right. So net income plus stock-based compensation plus dividends paid plus that should be the right formula. It's coming up red. We can take that. We can take a look at that in a second. You can see that that's too much, right? So let's just take a look. Let's see what we've done wrong. Again, quite a lot of that should be correct. Interesting to take a look. Now, maybe this is incorrect due to an item that the reason why it's incorrect, this is quite interesting. The reason why it's incorrect is because our net income line item there, 60 billion, is incorrect at the moment because it's incorrect down here because we've got incorrect levels of interest income and interest expense. So that will turn green once we get all the way down to the bottom. So at the moment, this is going to turn up as false and it's going to be red. But again, once we go back through the model, once we've done the cash flow, everything is going to go green. Well, at least that's what we hope. So let's check back in when we get to the cash flow, and hopefully these reds up here are going to turn green.